Good evening. Tonight, we're taking a closer look at why Wall Street, after a period of extraordinary momentum, is suddenly easing off the accelerator. The financial world has been buzzing with excitement as stocks soared to new heights, but now a sense of caution is settling in. After weeks of record-breaking gains, Wall Street is pausing. The energy on the trading floor has shifted from exuberance to a more measured, watchful mood. U.S. stock futures are slightly lower this Friday, signaling investors are catching their breath. The numbers aren't dramatic, but they're enough to make people pay attention. The Dow and S&P 500 futures dipped just 0.1%. Not panic, but a cautious step back after a powerful rally. It's a subtle reminder that markets can't climb forever without taking a break. Yesterday, all three major indices, the Dow, S&P 500, and Nasdaq, closed at new all-time highs, capping off a remarkable run. Investors have enjoyed a wave of optimism, fueled by strong earnings, positive economic data, and hopes for continued growth. But markets never move in a straight line. Even in the best of times, there are pauses, pullbacks, and moments of uncertainty. Volatility is part of the journey, and today's hesitation is a natural part of that cycle. This minor pullback is a natural pause, not a sign of trouble. In fact, many analysts see it as a healthy sign that investors are taking time to reassess before making their next move. Investors are now asking, is this just a breather or the start of a bigger correction? The debate is lively, with some pointing to strong fundamentals, while others warn of potential risks ahead. The answer depends on upcoming earnings, global events, and whether recent optimism holds up. Factors like inflation, interest rates, and geopolitical tensions are all in play, adding layers of complexity to the outlook. Every new data point is under the microscope, as traders weigh confidence against caution. Economic reports, company forecasts, and even political developments are being scrutinized for any sign of change. The market's mood is balanced on a knife's edge. Big gains, but plenty of uncertainty. For every optimist, there's a skeptic, and that tension is keeping everyone on alert. Even a single headline can shift sentiment fast. In today's hyper-connected world, news travels instantly, and markets can react in the blink of an eye. This morning's dip is a reminder. The rally's not over, but the crowd is watching the clock. Investors know that timing is everything, and many are waiting to see what happens next before making big moves. All eyes are now on today's major events, which could either reignite the rally or prompt some profit-taking. As the day unfolds, Wall Street will be watching every development, ready to react at a moment's notice. What powered this bull run? Two forces, the Federal Reserve and artificial intelligence. The Fed's recent rate cut made borrowing cheaper, fueling business expansion and consumer spending. Low rates pushed investors toward stocks, boosting confidence and driving prices higher. But it's not just easy money. AI mania has gripped the market. Companies leading in AI, from chip makers to software giants, have seen their stocks soar. Investors believe AI will spark a productivity revolution, benefiting nearly every sector. This optimism, combined with the Fed's support, created a perfect storm for record highs. Now, with so much good news priced in, the market is looking for proof that the hype is real. Today's big geopolitical event is unfolding. A high-stakes phone call between President Donald Trump and China's President Xi Jinping. The world is watching as these two powerful leaders connect, their conversation set to shape the future of a global tech giant and possibly the relationship between their nations. At the heart of their discussion is TikTok, the wildly popular social media app whose fate in the U.S. has become a flashpoint in the ongoing rivalry between Washington and Beijing. For months, TikTok's U.S. operations have been in limbo, caught in a tug-of-war between national security concerns, data privacy fears, and political maneuvering. Lawmakers and intelligence officials have raised alarms about the app's Chinese ownership, while millions of American users continue to scroll, post, and share. A proposed deal could see TikTok's U.S. arm placed under American control, with promises of stronger data safeguards and oversight. Yet, the negotiations are fraught with uncertainty. Key questions about who will ultimately own and manage the platform and how user data will be protected remain unresolved. President Trump's direct involvement adds another layer of unpredictability. He's weighing national security interests against the app's massive popularity, especially among young voters who make up a significant part of his audience. His decisions could sway public opinion and even impact the upcoming election. For President Xi, the stakes are equally high. TikTok represents not just a business interest, but a symbol of China's growing influence in global technology. Protecting this tech champion is about national pride and maintaining leverage in the digital economy. This phone call is more than just business negotiations. It's a diplomatic chess match, with each move carefully calculated. The outcome could redefine the balance of power in US-China relations, setting precedents for future tech disputes. The stakes extend far beyond politics. The outcome of these talks could either ease tensions and reassure global markets, or escalate the conflict, sending shockwaves through economies worldwide. Investors and analysts are watching every development closely. A successful deal could calm nerves, stabilize stock prices, and encourage further cooperation between the two superpowers. But if negotiations break down, the fallout could spark new volatility, rattling markets and deepening the divide between the US and China. The TikTok saga is more than just a business story. It's a microcosm of the broader tech and trade rivalry that defines our era. It highlights the challenges of globalization, digital security, and the race for technological dominance. What happens next could set the tone for future conflicts and cooperation, shaping the digital landscape for years to come. TikTok isn't just an app. It's a cultural and economic powerhouse that has transformed the way people connect, create, and consume content. What started as a platform for short, catchy videos has quickly become a global phenomenon, influencing trends, music, and even the way news spreads. With millions of US users logging in every day, TikTok is now a vital space for creators to build their brands, for small businesses to reach new customers, and for advertisers to tap into a young, engaged audience. It's a digital marketplace, a stage for self-expression, and a launchpad for viral movements, all rolled into one. The potential deal to create a US-based TikTok entity is worth billions of dollars, representing not just a business transaction, but a chance for American companies to gain a foothold in the fiercely competitive world of social media. For investors and tech giants, this is a rare opportunity to shape the future of digital communication. But the stakes go far beyond business and profit margins. The outcome of these negotiations could set a precedent for how global tech companies operate in an era of rising geopolitical tensions. TikTok now sits at the very center of the US-China tech rivalry, with Washington raising alarms about data privacy and national security, while Beijing remains deeply concerned about losing influence over one of its most successful tech exports. Negotiators face the daunting task of satisfying US security demands, protecting Chinese interests, and meeting the ambitions of global corporations. It's a delicate balancing act, with each side wary of giving up too much. If a deal is reached, it could serve as a blueprint for resolving future tech disputes between nations, showing that compromise is possible even in a divided world. But if talks collapse, the rift between the US and Chinese tech sectors could grow even wider, making cooperation harder and fueling further mistrust. The fate of TikTok has become a symbol, a proxy for the broader struggle over technology, power, and influence between two global superpowers. How this high-stakes drama unfolds will shape not just the future of TikTok, but the entire global tech landscape. The world is watching, waiting to see what comes next. In tech, a bombshell NVIDIA, the AI chip leader, just took a $5 billion stake in longtime rival Intel. Intel's stock soared 22% on the news, a huge vote of confidence. For years, NVIDIA and Intel have battled for chip supremacy, but this investment signals a strategic shift. NVIDIA may be looking to secure its supply chain by tapping Intel's US and European foundries, hedging against global disruptions. It's also a bet on Intel's turnaround and manufacturing push. This move could lead to future partnerships, with Intel making some of NVIDIA's chips. For Intel, it's a major endorsement and a capital boost. For NVIDIA, it's about influence and resilience in a volatile industry. The deal has analysts buzzing and could reshape the chip landscape. Sometimes rivals make the best allies. FedEx delivered a surprise strong earnings in a tough economy. Revenue beat expectations, but the real story is cost cutting. With global shipping volumes soft, FedEx slashed $1 billion in expenses, closing facilities and streamlining operations. This discipline protected profits even as growth slowed. Investors rewarded the company's smart execution. FedEx's turnaround shows the power of operational focus when the economy isn't booming. It's a playbook others may follow if growth stays sluggish. Sometimes, steady management outshines flashy growth. Overseas, the Bank of Japan kept rates steady but made a bigger move. It's starting to sell off its massive holdings of stocks and ETFs. For years, Japan's central bank bought assets to fight deflation, but now it's unwinding that stimulus. This shift signals the end of an era of ultra-loose policy. The Japanese stock market fell on the news as investors brace for a major seller entering the market. The move matters globally. Japan's actions can sway currencies and capital flows. As central banks tighten, markets lose some of their safety net. Investors everywhere need to adjust to a world with less support. The era of easy money is fading. Back home, Lenner's latest earnings reveal trouble in the housing market. Profits plunged 46% as the builder relied on incentives like mortgage rate buydowns to keep sales moving. These tactics help buyers but eat into margins. Lenner's forecast for home deliveries fell short, signaling ongoing challenges. High rates and affordability issues are capping demand, even with incentives. The report is a warning. The housing boom is cooling and the path ahead looks tougher. Builders are squeezed between rising costs and price-sensitive buyers. The market isn't crashing, but the easy gains are gone. Housing's next chapter will be a grind. So, what does all this mean for your money? In a word, uncertainty. The market's pause reflects a tug-of-war between AI optimism and real-world risks. For investors, it's time for caution and diversification. Don't bet everything on one trend. The TikTok saga shows how fast geopolitics can shake markets. Nvidia's Intel move and FedEx's cost-cutting highlight the value of strategy and discipline. The Bank of Japan's shift and Lenner's struggles remind us that global and local forces both matter. Stay informed, but don't overreact to every headline. The bull run has been remarkable, but the road ahead will be bumpier. Stay focused on your long-term goals and be ready for surprises.